Top retailers are announcing mass layoffs and hiring freezes as cracks in the U.S. economy continue to grow. Just like we witnessed during the last recession, retail chains are closing stores, reporting declining sales and facing massive inventory woes. The entire sector is facing one of the toughest stretches that we've seen since 2020, but analysts are saying that this is just the beginning. Even retail giant Walmart and e-commerce leader Amazon are being forced to slash their headcounts as consumers tighten their belts and spend less to cope with the soaring cost of living. Recent numbers are telling us that this crisis is really starting to accelerate, and things will get even rockier as the new recession gets rolling. A tidal wave of job cuts will sweep through the country in the final quarter of 2022 and extend well into 2023. If even the most powerful brands are struggling right now, this means smaller competitors are about to get crushed. That's what we're going to expose today. But before moving on, please support our work with a thumbs up in this video and don't forget to subscribe. In the wake of the downturn, companies across various industries are scrambling to stay afloat and letting employees go in an attempt to cut costs. In October, the total number of separations, which includes quits, layoffs, and discharges, rose to 5.7 million, at a rate of 3.9%, according to data from the Bureau of Labor Statistics. The situation has been particularly dire for retailers, given that the economy is shifting at a critical time as they march towards the all-important holiday shopping season. Right now, labor is top of mind for many companies, with inflation, inventory imbalances, and declining sales forcing them to rethink their workforces to get through the recession. Many have already signaled that a painful period is ahead, pointing to shortages, rising operational costs, and shifting consumer demand as some of the reasons why their profits have been shrinking. Shoppers are cutting back on discretionary spending amid rising living expenses, meaning that brands that count on their discretionary sales to prop up their balance sheets are going to suffer the most. Research released by Challenger Gray & Christmas found that the number of retail layoffs is climbing at the fastest pace since 2016. In September and October, roughly 12.785 employees lost their jobs in the retail industry, a whopping 92% spike compared to the same time last year when retailers were feverishly preparing for the 2021 holiday season, and only 1,023 retail workers were laid off. Very few companies have been able to avoid this downsizing trend. At this point, even the largest retailer in America has begun quietly laying off workers. According to Business Insider, Walmart is cutting 1,700 jobs by December the 2nd. The company shared concerns over the impact of inflation and falling sales rates. This year, the retail giant saw its profits decline by almost 25% after it was hit by expensive supply chain costs and a massive inventory glut of non-essential goods. CEO Doug McMillon said that Walmart was being forced to reduce prices across several categories to be able to get rid of non-selling stock. He noted that inflationary prices of fuel and food were affecting customers' ability to spend on certain sectors such as apparel. It'll start by cutting 200 corporate jobs and approximately 1,500 warehouse jobs. Workers started receiving notifications at the end of August. Retail Dive explains that federal law requires businesses with 100 or more employees to give 60 days advance notice of mass layoffs or other work disruptions. The cuts will start this month and be completed over the next 5 weeks. Brian Yarbrough, an analyst at Edward Jones, argues that competition with Amazon has also impacted Walmart's profits and led to this situation. When you're competing with Amazon, you can never stop. You always have to take the game to another level, Yarbrough said. The analyst also notes that more layoffs may soon be announced, because the company is experiencing a major slowdown in e-commerce growth. During the peak of the pandemic, Walmart's e-commerce sales skyrocketed, growing 97% year-over-year in the second quarter of 2020. But it's been all downhill from there. In the second quarter of 2020, Walmart's e-commerce sales grew by just 12% year-over-year. For decades, the retail giant has been aggressively expanding its business. Even after recent losses, the company's net and operating income is still far higher than most of its competitors, and it's also in far better shape than almost everyone else in the industry. So, the only way that it would make sense for Walmart to cut so many jobs in the fourth quarter of 2022 is if it anticipated that we are heading into an even more distressing retail environment in 2023. Its main competitor, Amazon, is also facing its fair share of difficulties. In fact, Amazon has abandoned multiple projects this year in an effort to reduce costs, which resulted in nearly 560 layoffs in the first quarter. In July, the company shuttered physical store concepts such as the Amazon 4-Star, Amazon Books, and several pop-up stores. The company said it laid off an additional 51 employees in New York due to those store closures. During the summer, the e-commerce giant filed a warn notice in Maryland saying it would cut 353 warehouse jobs by October 25th. In September, it announced the shutdown of the telehealth unit and laid off another 159 employees. At least another 300 jobs are on the line and may be cut by early 2023 as Amazon finishes its initial downsizing plan that eliminates 99,000 people from its workforce, CNBC reports. The e-commerce retailer is also freezing corporate hiring in its retail business for the rest of the year, according to an internal announcement obtained by the New York Times, making it the latest company to pull back amid the economic uncertainty. Walmart and Amazon are certainly not alone. FedEx, which competes with Amazon for delivering packages to customers, said last month it was freezing hiring, closing stores, and parking planes as demand dropped faster than it expected. Layoffs also continue to mount at Bed Bath & Beyond. The retailer announced that it will start closing 150 low-performing stores and reduce 20% of its workforce of corporate and supply chain employees as part of its restructuring plan. Similarly, PVH Corporation, which operates brands like Tommy Hilfiger, Calvin Klein, and Warner's, reported its third quarter results and revealed plans to reduce people costs by 10% by early 2023. The company said it expects these reductions will generate annual cost savings of over $100 million. CFO Zach Coughlin said in a statement that the cuts were being made to increase productivity and reinvest strategically in the digital, supply chain, and consumer engagement. At the same time, footwear and apparel retailer Rockier Brands Inc. announced a round of layoffs that will cut over 13% of its staff. Clothing reseller StockX is also reducing its headcount by 8%. CEO Scott Cutler announced the layoffs to employees in an email which said the company had taken measures to reduce costs by prioritizing existing investments, reducing discretionary expenses, placing limits on new hires, and improving efficiency in the company's trade process. In a statement to the Financial Times, StockX said that it needed to adapt and pivot its business to keep up with macroeconomic challenges that are currently impacting the economy and its business. Likewise, resale platform ThreadUp is slashing about 15% of its corporate workforce and shuttering one of its processing centers. CEO James Reinhart highlighted that the cost-cutting measures are being taken due to the deteriorating consumer health seen in recent months as inflation puts a damper on spending. Simultaneously, Steve Rendell, the president and CEO of VF Corporation, which owns Vans, The North Face, and Timberland, announced 600 layoffs in a letter to employees, according to a report from Denver Business Journal. Gap will also cut 5% of its corporate workforce, or about 500 employees, the Wall Street Journal reported. We've let our operating costs increase at a faster rate than our sales and in turn our profitability, Gap's interim CEO Bob Martin wrote in a memo to employees obtained by the Journal. This month, furniture and home goods company Wayfair is eliminating 870 jobs, which represent about 10% of its corporate team. And convenience store chain 7-Eleven is cutting 880 corporate jobs in Ohio and Texas, WSJ reported. These are just a few of a long list of retailers that are eliminating jobs right now. Many companies have been edging closer to bankruptcy this year, and their results on the coming holiday season may either save them or be a death sentence. During the health crisis, retail chains have faced one of the worst environments since 2008. Foot traffic sharply collapsed, sales declined dramatically, and real estate debt continued to pile up. Despite all of this, many businesses have proven to be surprisingly resilient. However, struggling retailers that sell mostly discretionary goods, cater to middle and lower income consumers, and have weak balance sheets will be at high risk of going bankrupt and closing stores in the next few months. But not only retailers are in such a vulnerable position, companies that recorded billionaire profits over the past couple of years are now seeing the tables being turned as financial conditions deteriorate due to rising interest rates. For example, Twitter is laying off 50% of its workforce. CEO Elon Musk revealed that the company is losing over $4 million a day. Peloton, who saw its shares soaring 73% in the second quarter of 2021, has laid off thousands of workers as its stocks crashed by 94% in September. The burst of the housing bubble also led real estate firms to reduce their headcounts. The latest example is RE/MAX, which slashed 17% of its workforce. Even traditionally layoff-resistant companies like Netflix are making cuts right now. The reason broadly is twofold. Business growth is slowing, while labor and operational costs are rising. The combination is leaving many American companies no other choice but to let their employees go. This accelerating trend highlights how rapidly the economy is weakening and the effect of the Fed's policies that aim to decelerate business growth and ramp up the unemployment rate so that Americans stop consuming at the current pace and inflation finally starts to fade away. With the goal of returning the current 8.6% inflation back to the 2% mark, the Fed is determined to raise rates even higher. But every rate hike means that many more jobs will be lost as businesses cope with tighter borrowing conditions. According to data compiled by the Cass Freight Index and analyzed by Wolf Richter, this slowdown is already showing up in the supply chain. Now it's the third month in a row, and the red flag is getting more visible and a little harder to ignore about the goods-based economy. Freight shipment volume in the United States across all modes of transportation, truck, rail, air, and barge, has fallen 2.1% from a year ago, according to the Cass Freight Index released today. The 3 months in a row of year-over-year declines are the first such declines since the transportation recession of 2015 and 2016, he wrote. In an ironic transformation compared to the retail environment of 2021, when a buying frenzy was causing inventory shortages all across the country, today the industry shortages are being caused by a lack of proper planning and a failure to address consumers' needs and shifting shopping patterns. Unsold goods are starting to pile up in U.S. warehouses at a rate that we haven't seen since the financial crisis. Considering that hundreds of retailers are barely clinging to life, their chances of surviving this economic meltdown are very small. By now, pretty much everyone agrees that in the months ahead, the economic scenario will look even grimmer. Consequently, more retail workers are gonna get laid off, more stores are gonna close, and retail apocalypse stories will start making the headlines again.